In today's video, I'm going to look at a couple of possibilities in the stock market. The last several intermediate cycles have lasted between 18 and 24 weeks. Next week is going to be week 19, so this intermediate cycle here is getting pretty mature. This could play out as two ways. We could either get maybe a small decline next week, followed by a left translated cycle that makes a little bit higher high and then moves down. That would give us something probably in the 23 to 24 week range for the intermediate cycle low. That's not really my preferred scenario, though. I think probably what's going to happen is that the Fed is going to want to keep the market propped up ahead of the rate hike. The odds have gone up above 70%, so the chances are now very good that the Fed is going to hike again on the March 15th meeting. They're not going to want the market going down into that Fed meeting, so I suspect the market's is going to remain propped up into the Fed meeting, and then we'll get our move down into the intermediate cycle low. It'll probably come as my guess anyway, is a violent reaction to the rate hike. So I'll give you some ideas of what I think is going to play out. We have what looks like here a T1 pattern in play, and the characteristics of a T1 pattern is you get a measured move followed by a sideways consolidation, and then once the breakout occurs, you get another move of roughly the similar size as the first. So roughly here we've got about a 200-point move in the S&P. We hit this consolidation zone, go sideways for about a month and a half, and then now we're starting the second leg up. It usually doesn't do as much as the first leg. So if we got 100 or 200 points here, then I would not expect exactly 200 points on this second leg. I would expect something maybe along the lines of 150 to 170 points. So in keeping with the Fed wanting to keep the market propped up into the FOMC, I think we may have a little further to go. The S&P may have to break out of this 2400 or break through this 2400 level, and then make a push, maybe even as high as 2450, somewhere in there, by the FOMC meeting. And then the way the corrective phase of these T1 patterns plays out is once you get the top, then you'll get a correction back down to test this the consolidation, the midpoint consolidation. So if we do next week and halfway through the FOMC meeting, if we can break through this 2400 and make it somewhere up near the 24, maybe 2450-ish area, then I would expect to see a violent 1 to 1.5 week move back down to test this consolidation zone, and when it does that, that would be your next buying opportunity, as I think we are starting the bubble phase of the bull market. And I've gone over these before. The bubble phase, from the time it starts to the time the bubble tops, usually lasts about a year to a year and a half, and typically you'll see a move of at least 100% or more within a year or less. So I'm going to suggest that the bubble phase started on that intervention on election night in the stock market, when the stock market was locked to limit down, and then we saw the futures reversed violently, and then the next day after the elections, the market closed positive. I would say that was the point at which, it just became clear to everyone in the world that the market was protected. That you got Fed protection, you got the plunge protection team protection in stocks. So this was the point at which everybody recognized that there really is no risk in the stock market. Any corrective move is going to be aborted or terminated prematurely. So that's the point at which the stock market became risk-free, and you can see exactly what has happened after that. Money has just piled in, and we've started this mini parabolic move. Although it's way too early yet for this to be the bubble top. Like I said, most bubbles you'll see 100% or more in a year or less before a bubble top. So I would not mistake this as the bubble top. I think we got a long ways to go yet. If we started this, if this was the start of the bubble, then 100% from here would be 36,000 on the Dow before the bubble top. But I don't think we're ready to just take off and never look back. I do think we've got to have a correction here. So in this long-term chart, this T1 pattern is readily evident. You can see this first leg up was about 2,000 points. We got this very obvious sideways consolidation. Another move of I would say 1,500 to 1,700 points would put the Dow maybe at 21.5 to 21.7 by the FOMC meeting, and then you would expect the market to generate a violent sell-off back down to test this consolidation zone here. And then once the consolidation zone is tested, then I think we would be off to the upside again. So my best guess is it's probably still a little bit too early to expect the correction. We probably still have another week and a half. My guess is that the market will stay propped up into the FOMC meeting and then probably have a violent reaction when the Fed raises rates again. That's my best guess. But when we come back down to test this consolidation zone, I think you have to be ready to buy again, because this bubble phase should still have at least another year to run before we put in a final top.